Hey guys, what's up? I'm Erin and welcome back to the channel. So you've worked your entire life and you're finally collecting Social Security, and then all of a sudden you're handing a piece of it right back to the IRS. This is one of the biggest frustrations I hear from retirees. Now, a new proposal in Congress is aiming to change that. It's called the You Earned It, You Keep It Act, and if it passes, it would eliminate federal taxes on Social Security benefits starting in 2026. But of course, there's a catch. So let's break down this bill, what it does, who would pay instead, and what it means for your retirement planning. The You Earned It, You Keep It Act is sponsored by Representative Angie Craig in the House and Senator Ruben Gallego in the Senate. Here's the core idea in plain English. This bill would end federal taxation on Social Security benefits, so you would no longer have to pay a portion of your benefit back to the IRS. To offset the lost revenue, it would reinstate Social Security payroll tax on wages and self-employment income of $250,000 and higher. If passed in 2025, the first tax-free year would be 2026. Payroll tax changes would apply to wages and self-employment income earned after 2025, and the new benefit credits for high earners would apply only to people who first become eligible for Social Security after 2025. So that's the bill at a quick glance. Now, before we go any further, let's clear up a potential source of confusion. Because if you saw headlines earlier this year on One Big Beautiful Bill, or OBBB, you might be thinking, didn't we already eliminate taxes on Social Security? Even the Social Security Administration put out a public statement saying that nearly 90% of beneficiaries would no longer pay federal income taxes on their benefits. That sounds like a done deal, right? Not so fast. Here's the reality. OBBB did not repeal taxes on Social Security. Section 86 of the tax code, the part that allows up to 85% of your benefits to be taxable, was not touched. What OBBB did was create a new $6,000 senior deduction, or $12,000 if you're married and filing jointly. That deduction can help reduce your tax bill if you're age 65 or older and your income falls within the phase-out ranges. For some retirees, it will effectively eliminate the taxes they would otherwise pay on their Social Security benefits, but it is an age-based deduction, and it has an income range where it works and an income range where it phases out, and it is temporary in nature, expiring in 2028. It's not tied to Social Security at all. So why would the Social Security Administration say 90% won't pay taxes? Well, they're basing it on a narrow definition of income from survey data that undercounts things like capital gains, lump sum retirement withdrawals, or business income. If you look at all sources of income, including data from the Federal Reserve, you will see that plenty of retirees will still be paying taxes on their Social Security benefits in 2025 and beyond. If you're interested, I have a full video dedicated to this, and I'll link it above and down below. That is why this new bill, You Earned It, You Keep It, is different. It's not relying on a deduction. It is actually addressing Section 86 with the attempt to repeal it, and if it passes, Social Security benefits would be tax-free at the federal level starting the following year. Alright, so now let's break down exactly how this bill would change today's rules. First, no more federal taxes on Social Security benefits. This is the showstopper. This is the headline that the bill is leading with. Right now, depending on your income, up to 85% of your Social Security benefits can be taxable. The thresholds are pretty low, $25,000 if you're single, $32,000 if you're married and filing jointly, and they've never been adjusted for inflation since the 1980s. Under this bill, that tax would disappear completely, so your Social Security would be yours in full, no taxes at the federal level, regardless of what your income looked like in retirement. Second, the payroll donut hole above $250,000. Today, Social Security payroll taxes 6.2% from employees and 6.2% from employers, and it only applies up to the wage base, which is $176,100 in 2025. That number is indexed for inflation. If you earn more than that, you stop paying the Social Security portion of payroll taxes on that portion of your income. Under this bill, the wage cap would still stay in place, but it would reintroduce a tax once incomes exceed $250,000. This essentially creates a donut hole where you pay taxes on wages up to the wage base, and then you don't pay Social Security payroll taxes on incomes between the wage base and $250,000. And then again, the tax would be introduced on incomes above $250,000. There's a reconciliation rule if you have multiple employers to make sure you'll still pay correctly once your combined wages cross that $250,000 threshold. If you're self-employed, you end up paying the full 12.4%. And railroad workers, they're included too. The same parallel changes would be introduced into their system. Now, here's something that's important. That $250,000 threshold written in this bill is not written in a way that it's indexed for inflation. So over time, it would include more and more people who would have incomes that surpass this limit. Also, the normal wage base is adjusted for inflation every single year. So essentially, it would be narrowing this donut hole over time. And if it ever crossed $250,000, which is very likely that it will down the road, we would essentially lose the donut hole altogether, and all wages would be subject to Social Security payroll taxes. Let's do a quick example. Suppose you earned $300,000. You'd pay Social Security tax on the first $176,100. Nothing from the income between that and just under $250,000. And then again, tax would be reintroduced at $250,000 to $300,000. Ultimately, you and your employer would owe an additional $3,100 in taxes. That's how the donut hole would work in practice. Third, we'd see a benefit credit for those with extra earnings. Here's how it works. Social Security calculates your benefits using your average indexed monthly earnings, or AIME. Today, that formula has 3 tiers. On the first slice of your AIME, you get a 90% replacement rate. On the next slice, you get 32%. On the highest slice, up to the wage base, you get 15%. That's the structure right now. Under this bill, there would be a brand new layer added for earnings $250,000 and higher, and that would be 2% of excess AIME. So let's compare. Instead of replacing 90 cents, 32 cents, or even 15 cents on the dollar, this new piece only replaces 2 cents on the dollar. The point is, you'd be paying payroll taxes on your high earnings and you would receive a bump in benefits, but it's a very small bump, much more modest than what we see in the formula as it is now. And that is intentional. The system was written in a progressive manner where higher earners are paying more in, but receiving lesser benefits on higher earnings. Fourth, this bill also introduces program financing tweaks. This part's a little bit more technical, but here's what it means. The bill makes small upward adjustments to the National Average Wage Index, or NAWI. That's the measure used to update Social Security formulas each year. By nudging it slightly higher, the bill makes sure benefits keep pace a little bit better over time. This bill also includes a hold harmless rule. This is important because a slight increase in benefits ensures that it would not disqualify somebody from SSI, Medicaid, or CHIP. So in other words, recipients of these benefits wouldn't lose their social safety net simply because the new formula allows them to receive a slightly higher benefit. So who really comes out ahead with this bill, and who ends up footing the bill? The clear winners are the middle and upper middle income retirees. Right now, this is the group that's paying federal taxes on their Social Security benefits. And if this bill passes, that tax goes away and they get to keep their full Social Security check. The group that's mostly unaffected, lower income retirees. This group is already not paying federal taxes on their Social Security benefits, so essentially nothing changes. And finally, who pays more? High earners making over $250,000 a year. They would once again be paying payroll taxes on incomes that are above this limit. Now, they would receive a small increase in benefit, but the increase in benefit would be much more modest than the taxes they're paying in. Now, let's talk timing, because If these changes hit, timing matters. If Congress were to pass this bill in 2025, your first tax-free Social Security year would be 2026, so the tax return you file in April of 2027. The payroll tax changes and the new benefit credits for high earners wouldn't start until after 2025, so the big takeaway is retirees could see their benefits tax-free as early as 2026, while the funding side of the equation would begin at the same time. Now let's talk about solvency. The sponsors of this bill say that it would extend the full solvency of Social Security until roughly the year 2058, which is a full 24 years longer than its current estimate. Now, this is important to note. This is their claim. The Congressional Budget Office has not scored this bill, so we don't have independent confirmation of this number. Instead, it is just what they are claiming as they put this bill forward. So what does all of this actually mean for you? Let's look at it from both angles. If the bill passes, starting in 2026, your Social Security benefits would no longer be taxed at the federal level. That would mean more money would be staying in your pocket. If you've been having federal tax withholdings from your benefits through Form W-4V, you'd want to revisit that and make sure you're not unnecessarily sending money to the IRS. This also might change how you think about your retirement income strategy. If you're no longer facing a tax bite on your Social Security, this might make Roth conversions more appealing in those early years of your retirement before RMDs kick in. Here you'd be moving money from a traditional account over into a Roth account where it could grow tax-free and wouldn't be subject to RMDs in the future, and you wouldn't have to be worried about bumping a greater portion of your Social Security into the taxable range. And as for those required minimum distributions, taking them would no longer cause a portion of your Social Security to be subject to taxes. That would ultimately give you more flexibility on how you draw from traditional 401k or IRAs, and it makes smoothing those RMDs across multiple years an even smarter play. At the same time, you don't want to forget about IRMA, those Medicare surcharges, because even if taxes at the federal level go away for Social Security, those IRMA thresholds are still there, so you want to plan accordingly. What about if the bill does not pass? Well, at that point, we would just assume that the current rules continue and up to 85% of your Social Security benefits could be taxable. In that case, strategies like smoothing RMDs, doing Roth conversions at strategic times, and using qualified charitable distributions to offset income all remain on the table. The strategy would remain the same. Ideally, with as much control as you can, take control of when and how you realize income to help prevent as much of your Social Security as you can from being taxed at a higher rate than necessary. Now let's talk about the odds. While this bill has been introduced, it is not scheduled for a vote, and expect plenty of pushback, especially when we start talking about expanding payroll taxes on higher income earners. Congress is quite divided, so it's going to be a very tough sell. So while the proposal is on the table, it's far from a sure thing. So could Social Security taxes on your benefits really disappear? It's possible, but it's far from guaranteed. If this proposal passes, retirees would keep a greater share of their checks starting in 2026. If it doesn't pass, the same rules continue. Either way, planning ahead is key. I'll keep you posted if we see movement with this bill within Congress. What are your thoughts on it? Leave them in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Here's the truth. OBBB. It's too many B's. It's too many B's. If you're self-employed, the same rule applies. Welcome to the Midwest. And you could do this without... That was the worst. If we see movement with this bill, what are your thoughts on it? Post in a comment. Wow, I just want to wrap up the video and be done. How you can within... I give up.